Next webinar from the Rural Banking Pain Points series is by our colleague David Hovhannisyan. Sorry, David, I'm still having issues with your name. And the title is Risk Management in Digital Finance. I will let David take it on from now and share some delightful knowledge on risk management in digital finance. Go ahead, David.
Thank you, Nicola. Hi, everyone. Good afternoon, Philippines. My name is David. I'm connecting to you from Armenia, from Eastern Europe. Little bit about my background. I started my career as a loan officer back then in 2004, and had a positions like a branch manager in a bank and then head of business unit. And last 5 years, I am involved in consultancy projects with international organizations, mainly in my home country, Armenia, in Southeast Asia, in Vietnam. And since February this year, I joined the Radian team, and I'm very happy to be in the Philippines and help Philippines market in the digitalization process. So my role here in Radian, it's called Solution Consultant. I help financial institutions with digitalization process and building the business case while going into digital with our core banking system, InstaFin. So I'm certified expert in microfinance and digital finance from Frankfurt School Management Finance, and very happy to be presenter to this interesting topic, in my opinion, risk management in digital finance. So yeah, let's go. Let me switch off my video, and let me start with the agenda. So today we're going to talk about what is digital strategy actually, and what key considerations in digital strategy the institution should look. Then we will talk about strategic partnership, and we will list the risks in digital finance, and we will talk about how to manage the risks in digital finance. And obviously in the end we will have a conclusion and we'll discuss the key takeaways from this presentation. Okay, let's start. So what is digital strategy? So some institutions might think that digital strategy is about IT department strategy or just a technology project. However, digital strategy, it's a holistic project for the institution. So digital strategy is a plan for how to support business goals by applying digital tools. Having a well-defined and clear digital strategy ensures that decisions about digital channels are not made merely in response to available technology, but are part of a coherent plan that enhances the user experience and maximizes the business opportunities. Please have a look on the words here: that maximizes business opportunities, support business goals. So I just want to recall the saying that when the Stone Age was over, it's not that because the stones were over in the world, that just the new technologies came. So what I want to say is that the lending business, the banking business is still going to be there, but with the digitalization that the lending business and banking business should be done with the digital tools to enhance the user experience and maximize the business opportunities. And let's see if the institution is going digital, what are the key questions that they have to answer? First of all, how the institution can be sure to select, implement, and run the best fit technology platform if they don't have sufficient IT expertise and have a limited budget. Yeah. So second, how to make sure that the systems are sufficiently protected against system outages or hacking. And a third, very important, how to prepare the staff for this digital journey. Okay, let's go a bit into details. What is when actually the digital journey is starting? Digital journey is starting from the opportunity assessment, and opportunities has to be assessed as internally as well externally. So internally, first of all, let's have a look on our vision and mission, whether the digitalization is going in line with our mission and vision. Second, product and services, what we offer now, what technological capacity do we have now, and what is the IT environment and strategy within the institution. So that's internally, yeah. And externally, What are the client needs and demands? So what is the behavior of customers? What is the market is asking? Second, let's not forget about competition. What is the competition? What is the IT landscape in our area of the world, in our region? For example, what are the available smartphones and what are the available mobile devices that can be used for the digitalization? And what is our strategic partnership? And of course, let's not forget about the regulatory environment. So in this presentation, we will specifically talk in the next slides about the strategic partnership. So strategic partnership actually with the digital channels, it's a crucial part of the digitalization process, because the solution that you're gonna use or the service that you're gonna use, it's not just a supplier for the stationery or water. It's a mission critical service that has to be very carefully selected and very well assessed. So strategic partnership, it starts that operationally, technically, and commercially that enlightened with the institution. So key questions when you are selecting a partner should be here, for example, what are their current infrastructure and outreach? How is their track record? What is the state of the core banking system? Isn't an API available? API, it's a application program interface to connect with, integrate with other solutions. And which is the hosting scenarios are offered? Which is a dedicated hosting service, is a cloud hosting, dedicated or shared, etc. Yeah. So as well, when you are selecting a partner, the regulations also has to be very well assessed. First of all, the country regulations, government regulations. Are there any government regulations currently and potentially in the future that affect our project? Then we have to consider the security standards. Does my new solution comply with the regulatory requirements on data security standards? As well, about the BSP regulation changes. What needs to be compliant with these regulations in short and long run? How ready, how capable is the service provider for the regulatory changes? I just want to remind about one scenario that happened in March, April, when the BSP announced that mandatory moratorium for all regulated institutions for the loans. So you have to consider when you are having a partner, that partner is meeting that requirement or not. Okay. So of course, when we have our selection criteria and we can consider the regulatory environment, we have to think also about the business case. And yes, with the digitalization, institutions should gain efficiency while having a direct cost savings and indirect cost savings. So direct cost savings would be hardware and servers and maintenance, additional manpower, time of manual accounting and report preparation. An indirect cost could be potential data loss, losing of business because of longer processes, system downtime, so opportunity assessment, opportunity cost, staff allocation and focus on growth. So staff could focus on intellectual work and rather to manual work, as well customer support. Yeah. And when we all put together that with the digitalization process, institutions should expect an efficiency gain, significant efficiency gain. Okay, now let's talk about strategic partnership that I mentioned earlier. So what is that actually, strategic partnership? There are actually many vendors in the market, right? There are large ones, small ones, there are expensive services, there are cheap services. There as well that vendors are offering technologies, on-premise, cloud, hosting is a question, and whether they are compliant or not compliant or half compliant or partially compliant. Yeah. So the thing is that when institution is selecting a partner, they should not rush with it. So some banks may ask the following questions: is the cheapest solution is the right solution for me? Does the vendor who pursues with the most aggressive marketing provide the right technology for me? So this has to be very well assessed. And the partnership cycle, actually, it starts first of all with identifying the partner. Yeah, when you look at the partners, you build a relationship first of all. You have a detailed product demo. Some institutions might ask for the testing account to have an access and to have the user experience on their own. However, having a detailed demo with the representative of the institution is very important here, that whatever any questions are coming from the users, that questions and the value of the user experience will be explained by the representative. And the business case value, as we mentioned earlier, that when we select a partner, we have to see what is the business case, what we're going to earn, what we're going to save, or what efficiency we're going to gain with this partnership. As well, the resource planning, of course. Then, when we identify the partner, we have to organize that partnership. So, first of all, to have a buy-in from senior leaders, to have a proper project team with sufficient authority, and create cross-departmental teams that everybody in the institution is actually contributing in the digitalization process. It's not just the project team's task to go into digital, but everybody is contributes. As well, it's very important at this stage to have engaged with the mid-level and specialist staff in the research level or in the assessment level as much as possible. So after identifying and organizing, we have implementation of that solution, right? So we integrate our system with that solution. Then we see whether our system is supporting, or that system, whether we are looking at having an open API. Then we pilot and we scale. And here is very important that when you are selecting a partner, that partner has an experience and technological capacity with the implementation. So it's very important here to, again, assess whether that implementation is going to be first one. Are you the first institution that they are going to implement their solution, etc., etc.? So it's very important when you're selecting someone that has a local experience, and that, because after each institution you are having more value and more experience in the implementation and know the challenges in advance. As well, when we implement, that goes to managing the partnership. So we secure the stability that both sides have a sufficient cash flow. For example, if there's again needed something to be developed, and if the institution is growing and scaling, whether the fintech partner has the capacity to step in line with the growth of the institution and the meet demand, service demand of the partner. And as well, of course, monitoring and evaluating of the partnership. Yeah, after some time, when we have a successful implementation and we are having experience together, let's see what other projects can be done together and monitor what can be sharpened in our partnership. So okay, let's if we selected the partner and we assessed and identified and organized the partnership, let's see what risks actually will come with the digital finance. So I'm going to in next slides I'm going to have I am going to list several risks, and I will start with the partnership risk, right, as we were discussing earlier. So a poorly selected vendor does not meet expectations and deliverables. We have situation when the vendor is not meeting the expectations. We are having system interrupts, so not the partner is not meeting SLAs, so service level agreements. And then we are having a difficult relationships, unclear segregation of duties and responsibilities. There's no clear who is going to do what and who is responsible for. So these are just the practical examples of a partnership risk. So when we are selecting a partner, these are the key questions that we should answer. Is there a contract or an MOU, Memorandum of Understanding, with a partner that includes protections and contingency plans? Did we agree on a technical escalation process to resolve incidents? Do we have a process on that or not? Is there a clear segregation of duties and responsibilities? So when you have a partner, these key questions to be considered. Next comes technology risk. Yeah, so transaction breakdowns due to hacking, power failure, or system faults. The system is not available, technical issues due to hosting. So the system itself does not have a problem, but the hosting has a problem. Then we select the technology, but we see that actually we are not able to integrate with someone else. So for example, if we select a core banking system, the core banking system does not have an open API to connect to other systems. And then, for example, the primary service breaks down, loss of transaction records. So that all these are technology risks that has to be assessed. And then to address these risks, the key questions are the following. Is there a disaster recovery information security policy in place to prevent loss or leakage of sensitive information? Are service providers, whether it would be a core banking system or mobile app or other, are they effective in their security protocols and risk management approaches? Is our software adequately communicating with devices to minimize transaction failures? Next, let's not forget about the reputational risk with the digitalization. So one example could be the technology failure. So customers are hesitant to use the digital channel because it's having failures. So then we have a poor customer experience, which leads to a loss of trust. And then we have a situation when, for example, case of security leak went public, and that resulted that our customers are going to our competitors. So these are reputational risks. When we are going into digital, from the reputational risk point of view, we should answer to these three key questions at least. Are we aware of the monetary value of our reputation and what it would cost to lose it? Do we have a clear standard linked to preservation of reputation and integrity? Do we have a customer support line for customers and agents for these cases? For example, if something is not working, whether the user can access the customer support. So this to be considered. Then let's not forget, of course, about the regulatory risk. So imagine if you have a solution and that solution it does not meet the requirements of know your customer, KYC requirements by the regulator, and or the customer data is sold to a third party which is not in line with the country laws and regulations. So this is regulatory risk that again has to be well assessed. And key questions here: do our core banking system and other integrated mobile apps comply with the local regulations? Are we fully aware of the regulatory requirements that concern the institution and business model? Do we fully comply with these requirements, or partially, or some? Is the partner able to ensure continuous compliance? So if there's anything changing in the market, do they have a process for that? Do they have a capacity to meet the continuous, to meet the compliance continuously? And then let's not forget about the strategy risk. Yeah, that could be also a risk that we're having the wrong strategy in the digitalization. Example could be launching a digital channel without properly assessing customer proposition, technology specifications and resources needed, and core banking systems API support. So that would bring, for example, in a situation when the customers are facing lack of interoperability. So this prevents customers from transacting from desired party. Imagine a lot of resources are invested, a lot of time has spent, but the customer proposition was not well assessed. So as well, key questions here will be: is my strategy well defined and research around internal and external factors? So here, am I just looking for the digitalization because I've heard of it, because my competitors are doing that? Is my strategy well researched? How broad are the risks that we are facing? Have we considered risk scenarios to test our plan? what is our risk appetite actually? And let's not forget the next one about operational risks. For example, customers gain access to another customer's PIN, agents sign up customers that do not provide accurate KYC information in order to earn commission. Employees use access to passwords of customers to conduct fraudulent transactions. So these are examples of operational risks. So again, key questions to be answered. Are we constantly monitoring and reviewing the fraud risk management strategy? Does our system have a proper user management module to minimize fraudulent possibilities? So yeah, these were some examples of the list. Maybe we could go a bit even more further, but I think you got the idea, right? That when we select a partnership and when we go to digital, several risks to be defined, and the key questions to be answered. And now let's see if we define the risk, if we see the risks, but this risk anyway going to be there, and let's see how we're going to manage and have a risk management in a digital finance. So first thing first, let's have a definition. What is the risk management framework? Risk management framework is a set of components that provide the foundations and organizational arrangements for designing, implementing, monitoring, reviewing, and constantly improving risk management throughout the organization. So let's see what I mean here actually. So process of the risk management is first of all establishing the context, identifying and classifying the risk, analyzing and evaluating the risk, responding to the risk, whether we tolerate, we treat, we transfer, or we terminate the risk, and then after the previous steps taken, reassessing that risk. So risk management framework starts with the risk management team. A potential risk management team in digital financing services could be the following members. So members from the risk management, from operational risk, digital channel management team, IT, finance, internal control, and compliance. So that could be a potential committee, let's say, about the risk management in digital finance. And once we have a team, let's establish the context and identify the risk. We have to define clear roles and responsibilities of multidisciplinary project team, setting a timeline and budget, establishing the risk tolerance levels under which threshold the risk will be accepted. We have to develop processes, methodology, definitions, and templates. For example, a risk register. I will talk a bit later on this. And then we have to identify the risk. So we'll have to lay out the major incident that could happen and constantly review and assess them on an ongoing basis. For example, potential like 4 incidents, major incident that could happen could be start from agent and distribution strategy, from the technology partner contracts, from local regulatory guidelines, and then identified risk then have to be recorded in the register that and the clear descriptions and the roles to be defined. Once we identified the risk, we have to rank them. We have to analyze them and rank them. So in this simple matrix, in the column and the row, you can see the impact and the probability. So based on the impact and the probability, either we will accept the risk, so for the low impact and that no actions are required, we will terminate the risk. For example, actions are required to ensure that the risk cannot occur or affect the project. We can transfer the risk to a third party that is in a better position to address the risk, for example, insurance company or other. Treat the risk, so decide on responses to mitigate the risk. And after the previous 4 steps taken, reassess the risk. Maybe something from the high impact, after taking some steps, will become actually a low impact or medium impact risk. So this continuous process has to be taken continuously. And every risk has to be assessed, monitored, ranked, and strategy to be applied. Now I'm going to talk about the so-called risk register that I was mentioning, which is basically a matrix where you have the risk-related information with its descriptions, with the ownership, with the approaches, etc., etc. And with the practical example, I have two examples here, which is the following. So first of all, let's imagine we have a situation when our partner, let's say a mobile app, starting to target the same customers that we are working with. So risk category will be the strategic risk or partnership risk. Risk name will be competing partner. Risk description, short description, will be direct competing for the same customers, which is slower head of mobile money. What is the cause? Misunderstanding of competitive threat and large market opportunity. So partner, and between the partner and the bank, there's a misunderstanding of the competitive threat. Effect, slow product uptake and customer churn. Probability, 2 out of 5 customers, which is little likelihood, that given the thorough partner selection process and prior research. Impact, 2 out of 5 customers. Here we could say it's a low impact given the large market that could easily be shared. However, for the small market, that could be not that small. So risk strategy would be whether accept, treat, terminate, or transfer. Here we had treat the risk. What would be the treatment strategy? Conduct the market research, diversify partner network and dependency. A tactical response on the risk will be signing a specific contract or memorandum of understanding with partners to define exclusivity and ownership of the customer. So what is the difference between treatment strategy and tactical response? Is strategy is more macro level, broader strategy, and even the word says strategy, how to prevent this risk, but tactical response, so specific action contract with partners, for example, to define the ownership of the customer. And then we have a key risk indicator, customer complaints, registering of customer churn or leaving reason in the system. And here again, the system, whatever system you use, that has to support this feature when the customer is closing account or leaving the bank, that information about the reason has to be supported by the core banking system. And current status has not occurred. Another example, it's an operational risk example, and you can see the risk register for that example is agency management risk. So risk name is overcharging of customers. That we have a situation, we have applied, we have a partnership with a mobile agency app. However, our agents are overcharging our customers. So short description is risk. An agent overcharges or charges additional fees to customers. Who is the owner of this risk? Head of Digital Finance Service Department is the owner. What is the cause of this risk? Service fees are often unknown to customers, and agents are capital constrained. So agents, maybe they're earning less, and there is no education between the bank and the customers. The customers do not know the fee rates, and the agents are taking advantage. So what is the effect of this risk? Reputational damage and customer churn. Customers are leaving them. So probability, true, 3 out of 5, which is a moderate likelihood. Impact, 2 out of 5, impact decreases. So during the lifetime of the product, some customers are getting trust and the number is decreasing. What would be the risk strategy? Is treating the risk. The treatment strategy would be increased transparency and charge more penalties from agents. So the tactical response will be reevaluate the commission structure, adjust agent contract. Here in the treatment strategy could be also applying a notification or SMS when the customer is doing a transaction, a customer receiving an SMS. And that also has to be supported by the core banking system. Key risk indicators, customer complaints, and agent monitoring. And for agent monitoring, here we also need to have a proper reporting tool. So our system has to support that monitoring tool that we can control what's going on. And the current status has not occurred. So this was the second practical example of the risk register with an operational risk, which was actually my last slide before the key takeaways. So I'm going to conclude my presentation, and I have this following key takeaways. The first, a digital strategy is not just an IT project or a project for IT department. It's a global project for all departments within the institution. It is imperative that all levels, from board to specialist, share, commit, and contribute with their potential and experience to the digitalization process. Second, digital strategy starts with internal and external analysis, customer needs, and the market opportunities to be in the center. Digital partner selection process is a crucial component and should not be in a rush. Everything that partner offered, technology, track record, product detail demo, hosting, data security, standards, customer support, business case, compliance with the local regulator has to be thoroughly assessed. Risks in digital finance need to be well managed. Risk management teams or committee, risk mitigating policies, risk register to be developed and implemented and tracked. The core banking system modules have to be flexible to address risk management. So core banking systems modules not to be only for the user experience or for the sales, but also for the risk management to address the challenges. Okay, so yeah, this is it from my side. I thank you very much for your time and for your listening to me. I look forward for your questions, and yeah, on the screen you can see my email, and if there's anything you would like to discuss or ask more questions, please feel free to send an email.